Hi everyone, welcome to today's class. So on today's class, we will speak about tech stocks and investing in this sector. But before I break down this sector for you, let me speak about Peter Thiel's concentric circle theory that he explained in the book 0 to 1. According to this theory, great businesses are good at building different categories of concentric circles. They start with a core competitive advantage and they rationally expand beyond that. This is the key discussion that we are going to have, and I will cover the following key points. One, I will give you an industry overview of the tech stocks and tech sector in India. Second, I am going to talk about some of the key developments that are happening in this space. We will also discuss some of the important points associated with this industry. And finally, we will prepare an investment checklist. So let's get this class started. The technology sector in India can be easily understood by looking at three simple points. First and foremost, the IT sector or information technology sector has revolutionized and set the base ground for technology innovation. So let us try to understand these points in simple bullet points format. First and foremost, when you look at companies like TCS, Wipro, they are heavyweights in Nifty. Their weight is roughly 20%. Second key point, these companies have reshaped cities like Bangalore, Hyderabad, where there is a lot of influx of educated engineers who are transforming the entire technology ecosystem and creating these mini technology hubs. There is a reason why Bangalore is called as mini Silicon Valley. Another key point to note about this industry is that this industry, unfortunately, is a back-end industry, not a front-end engine. When you consider companies like Google, Microsoft, they are considered to be front-end engines of technology. But TCS, Wipro, these type of companies are mostly service-based and they provide a lot of back-end support for these primary organizations. The final point about the IT industry is that this is a human capital-driven industry. There is a reason why India dominates the IT space because we have a well-educated workforce, because of which the IT revolution has taken place in India. The second critical point that you need to understand about the technology market is that it is getting shaped quite aggressively by the startup space. Take a look at this particular graphic. It will show you the startup funding that is taking place in India. And every single year, you will see this startup funding going up. In fact, in 2021, the performance of the Indian startup system was very, very promising when we ended up creating approximately 44 unicorns. Consider, for example, Zomato. It has successfully proven the 30-minute delivery model. Now it is moving towards the 10-minute delivery model. So it is revolutionizing the logistics and delivery space in India. Polygon Matic is revolutionizing the blockchain network. It acts as a main sidechain network for Ethereum, which is one of the top 2 protocols in the cryptocurrency space. So the startup story in India looks very, very promising with increased funding and some of these startups becoming revolutionary in their approach. The third and final point that we need to understand about the Indian technology sector is that what is it that we are precisely missing? So there are 2 critical ingredients that we are missing. First and foremost, Indian technology companies are not dominating at a global level. For example, if you compare Indian companies to Microsoft, Amazon, Netflix, then Indian companies are not competing at a global level. The second key ingredient that we are missing is that we are not experimenting enough with niche technology spaces. Consider, for example, here the American tech ecosystem. You have companies like UiPath, which have become fairly big in the robotic process automation space. You have companies like Palantir, which is dominating the artificial intelligence space. So in India, our technology ecosystem is mostly service-driven and not geared towards being market dominant globally. Now, as a next point, let us try to build an investment thesis and understand some of the key critical points that will help you out in terms of being a better investor in tech. So, if you're looking to invest in tech stocks, then you must understand about the concentric circle story. Before I take you there, let me tell you a very interesting anecdote about Mr. Aditya Puri, who built the HDFC Bank. So Mr. Puri was asked a question that don't you think that fintech organizations are going to disrupt HDFC's banking model? So he said that technology is common to all. It is highly democratic and anyone can use technology, but people generally do not control the brand. And we have branding power. So what he was essentially saying was that we have a moat, we have a concentric circle that we have already built. So let me now present that to you in slightly more detail. So this is what a concentric circle looks like. Step 1 of this concentric circle is building some kind of a competitive moat or competitive advantage. When Mr. Adityapuri spoke about HDFC Bank, the competitive advantage of HDFC Bank was its brand or brand value. So once a company builds that competitive advantage, it moves to stage 2, which is market expansion stage and moving to new markets, geographies or product line. And then comes the third key advantage, which is expansion of product line, services and market dominance. Let's understand this through one more example of Amazon. In step 1, Amazon became a monopoly ebook seller. In step 2, it started selling everything online. In step 3, it moved to new products and services like AWS. And if you actually look at the new acquisitions for Amazon, and here is a list for you, you will clearly see that it is developing this third step more and more with each passing year. The same example is depicted by Facebook. In step 1, it dominated the social media space, strengthened its core. In step 2, it started going to other social media platforms, so to say, by acquiring companies like Instagram and Snapchat. And now it is moving into metaverse, which is a part of its step 3 strategy. So this concentric circle works out wonderfully well if you are strengthening this core and building some kind of key advantage. Let me talk about another parallel example here about a company where this concentric circle theory is somewhat playing out, but it is not winning the game. A case in point here would be something like Paytm. It started out with its wallet system or wallet, but unfortunately that business was not very profitable. So Paytm was unable to strengthen its core and really dominate that step 1. Yes, it tried to go to step 2, step 3 very quickly, but unfortunately it does not have a single business line as of now, which is churning into a profit-making machine. So while investing in these tech type of companies, it is very important to keep this concentric circle theory in mind so that you can pick and identify businesses that will eventually become market leaders and dominate the space. Why is that important? I will teach you that in the next step. We need to study this framework through the lens of key developments that are taking place in this industry. And there are 3 specific points that I would like to cover. First and foremost, tech is becoming a winner-take-all market. Take a look at any dominant market player. Pick e-commerce, Amazon is one of the leading organizations by a huge margin. Similarly, if you take a look at social media space, we have Facebook. So the point is that even large or big tech companies are becoming bigger by each passing year. Why is that the case? The profit margins are really big, and as a result, these tech companies have a lot of cash that is sitting on their balance sheet. Now, this can be plowed back in order to improve their competitive advantage and strengthen this step 1 and step 2. And that is how these companies become world market dominant players. This brings us to the second key point, that the front-end tech or new age tech is very fast changing. For example, study the case of Nokia or Samsung and think about it, that a few years back or probably a decade and a half back, almost everyone was using a Nokia phone. Now, how many people do you see who are using Nokia phone? Now, why did that change happen? Because the technology got disrupted. Same is true when you are studying technologies like artificial intelligence or robotic process automation, that they will make a lot of companies obsolete, lot of existing technologies obsolete. So as an investor, you need to keep a track of these evolving trends. For example, Zomato, Swiggy, OTT platforms, social networking websites, all of the major technology companies that have been able to successfully scale have exhibited this networking effect. So as an investor, it becomes extremely important for you to keep a track and start noticing these trends. With that said, let me leave you with an important checklist that will help you become an even better investor. So here is a checklist for investors. First and foremost, figure out what the moat of that technology stock is. Go back to that concentric circle theory and see if step 1, 2, and 3 are being exhibited or not. Number 2, take a look at the addressable market size of the stock in which you are investing. Consider, for example, Facebook, which owns WhatsApp, and WhatsApp itself caters to 2 billion audiences every single month, which is 25% of the population on Earth. So whichever tech stock you are picking, ensure that it has a big enough market size. Third, take a look at whether the company in which you are investing, can it potentially become a monopoly? The reason there is again fairly simple, that good tech stocks end up eventually becoming monopolies, for example, Google, Facebook, Netflix, and that is when people make great returns from their stock purchases. So consider these key points before making your decisions. You might ask, what about the ratios? So let me give you very quick commentary there. So first and foremost, people tend to debate about the price to earnings ratio or the PE ratio. And generally it is found that in tech companies, this is given very high valuations. For example, recently in the Indian stock market, when Nykaa got listed, it roughly got listed at 1300 PE ratio. That is a very high number. Now the story gets even complicated because many of the tech stocks are not profitable. In such scenarios, you should not look at PE. Rather, you should look at ratios like price to sales. That will give you a better understanding. In some instances, it might make a lot more sense to take a look at PEG ratio or price to equity growth ratio. This will help you understand what type of stocks to avoid versus what type of stocks to pick. I hope you found this discussion to be insightful, and I will see you on the next session.